Walk me through, Gary, different types of business entities. I think this perplexes all of us in the very beginning because we hear LLC, S Corp, C Corp, partnership, LLC, whatever it might be. Can you break that down for us simply, really high level, and then we could pick apart the most common ones?
Again, this could be a topic for
Let's
last
go.
hours.
Let's do it.
But,
this is an important one.
We're going to start at the lowest level. A sole proprietor, somebody who just opens up a business under their own name. Matt Geller, OD. There we go. He's a sole proprietor. He files a form with his tax return that basically has his income and his business expenses. If Matt wanted certain legal protections, not from malpractice, but other types of legal protections, he can make it an LLC. So it would be Matt Geller, OD, LLC.
Yay.
But it's the same
Nice
tax
commentary.
filing. It's still another form that's just attached to his tax return showing his income and his expenses. If Matt wants to go into a partnership with another OD, he can form a partnership and then elect to be an LLC or file LLC forms to give him those certain legal protections beyond the malpractice. Then a separate tax return is filed for that partnership. There is no salary to any owner of an LLC. They get either what's called a guaranteed payment or just a distribution of profits.
So let's focus on that's the thing that trips up everyone. That means that yes, you are getting paid, don't worry, but you're not necessarily writing yourself. You can take a distribution however frequently you want, but it's not you're not on payroll for that company because
Right.
you are the owner or the partnership owner. It passes through. Pass-through entity.
Pass-through entity. You've learned, you see?
Heard it
You
enough.
do listen to what I say to
he
you.
is listening.
Okay, it's a pass-through entity, meaning that the income passes through to you. But the income in an LLC and in a sole proprietorship passes through to you as self-employment earnings, meaning that you have to pay 7.65% of Social Security and Medicare, and because you're also your own employer, the other 7.65% of Social Security and Medicare. If you're an employee, you have 7.65% of your salary withheld from your paycheck, and your employer matches that. When you're your own boss, either a sole proprietor or an LLC, you've got to do both sides of that matching as well. So if you're a partnership, you don't draw a salary, you draw a distribution of profits. If you decide one of the partners is going to manage the practice and we want to give him something extra, we're going to pay him $500 a week to manage the practice, that's a guaranteed payment. He's guaranteed to get that to manage the practice, and then you share the profits. Profits don't have to be shared equally. The ownership doesn't have to be equal. With an LLC, the ownership could be 50-50 and the profits are 75-25. There's a lot of variations that could happen on that.
That gets written into the contract, into
Right.
the operating agreement for the contract.
It's the operating agreement, and every year you can update the operating agreement to decide what the partners want to do.
So that means the money in the bank account, if you have a separate business bank account, the money that sits there, whether you moved it to your personal bank account or not, that is still your income. The profits left over based on your equity ownership is still your income. Just because you didn't move it to another account doesn't mean anything. You still file it.
That's why it's called a pass-through entity. The income passes through to you whether you take it or not.
Got it. All right, S Corp. Go ahead.
And I'm sure Gary's had the same situation as well, where you have a practice owner that said, "Well, I don't want to move it over to my personal account because I don't want to pay taxes on it."
Wrong answer.
I'm sorry, I don't mean to burst your bubble, but that's the IRS doesn't see your bank account. That's not how things work. So it doesn't matter what bank account it's sitting in. At the end of the day, the numbers add up, and it's going to find its way on your personal return, whether you like it or not.
Got it. All right, S Corp.
S Corp. Okay, let's talk about just corporation in general, and then we'll get to the S Corp. A corporation in general is General Motors, Ford. They're corporations. They're what's known as a C corporation. In a C corporation, if the company has earnings and profits, you can take them out as a dividend. But the corporation first has to pay a tax on it. Also in a corporation, the active owners of a corporation draw a salary from that corporation. So now we'll jump over to what an S corporation is. An S corporation is an election by the corporation to be taxed as a pass-through entity, similar to an LLC. But the profits that flow through to you from an S corporation are not subject to that self-employment tax that we spoke about. That's why you have to take a salary. The government requires you to take a reasonable salary. There's no definition of reasonable, but they require you to take a reasonable salary from that S corporation. And if there's any profits left over, you can draw out those profits without having to pay the extra self-employment tax on it.
So is there no corporate tax there? It's just your payroll tax on your salary, and then it's your income tax on the profits you draw.
On an S corporation, that's correct, except
Okay.
in New York City.
Oh boy. Well, we're in Vegas today, so
Okay.
forget about New York City. Keep going. Do you have something to add? Okay. C corp
C
and the tax. And
okay. Well, I mentioned the C corporation is like a General Motors or a Ford, but you can, if you form a corporation, it's automatically a C corporation. A C corporation, you would draw a salary from the corporation, and if there are profits left over, you can take a dividend. But first, the corporation has to pay a tax on those profits, and then when you get the dividend, you pay a tax personally on the dividend. So the corporation has a graduated tax rate, and if you can plan it right, if the corporation's profits are less than $50,000, the tax rate for the corporation is 15%. If you get a dividend from the corporation, the tax on a dividend is 20%. So combined, that's 35%. The highest personal income tax bracket is 39%. If you took it all as salary, you might be taxed at the higher rate. But if you're active in the corporation, you can't take it all as a dividend. You have to take salary, a reasonable amount of salary. We go back to that again.
so why on earth would anyone choose to be a C corp when you could be an S corp and it sounds like avoid some of the tax situation? And I know one answer because we encountered it. If you want different classes of shares, meaning you want to have investors or people who have different liquidation preferences or change up the shares, you have to be a C corp.
Exactly.
One class of shares for S corp. Any other reason?
An S corp is limited to one class of shares. An S corp is limited to pretty much individuals only, except certain trusts and estates are allowed to be owners of an S corporation. You're limited to 100 shareholders in an S corporation, and you have to be a U.S. citizen or resident to be a member of an S corporation.
Got it.
Okay, but there are some advantages sometimes to be a C corporation, not necessarily for an optometrist, but other types of businesses. There's one other thing with S corporation versus LLC. An LLC is very flexible. You can own 50% and share the profit 75-25. With an S corporation, whatever your ownership is, that's the way you have to share the profits. You may be able to finesse it with salary, but sometimes it's hard to do as you get close to the year end.
Got it.
One other thing that I would add on the from an S corporation standpoint, as Gary mentioned about reasonable compensation versus distributions to save on paying yourself the Social Security and Medicare side, as both the employee and the owner of the practice. You can't have your cake and eat it too if you have a 401k plan or a simple IRA. The match that, if you think of yourself wearing two hats, both as the employee and the business owner, the match that you give yourself is only calculated based off of the W-2 earnings. So you can't pay yourself on maybe the low end, a quote-unquote reasonable compensation of $60,000 and take a $100,000 pass-through, which I think we would both agree yeah, exactly, that's not reasonable, and then take a match on the full 160. Your match on a retirement plan is limited to the amount of W-2 wages that you pay yourself.
The IRS, or rather the tax code, defines it as earned income.
Now, you could take losses in your business, and that offsets some of your tax. You want to give us a little snippet on that, how that works? If you could have losses for a few years and then count that against any profits?
If you have, well, we're talking S corporation now?
Oh, man.
Because,
You decide.
because if
We're going deep now.
Because if you have a loss in an LLC, you really lost money.
Right.
If you have a loss in an S corporation, you may have caused the loss by taking too much compensation. You took unreasonably too much money out, which may be frowned upon by the IRS if you're trying to make a large contribution to your retirement plan. You can't create the loss to get that contribution to the retirement plan. But let's say it's a legitimate loss in the S corporation. Yes, you are able to use that loss to offset other income if you have basis in your S corporation. And I saw your eyes just glaze over.
We just lost the rest of our audience with that.
Basically,
esotropia
if
came
you're
out.
at risk for the amount of money that's in the corporation, then you have basis. So, for example, corporation has a loss of $1,000, and in order for it to cover its bills, you as the owner lent the company the $1,000. To do that, that gives you basis. You can take the loss on your personal tax return. However, if you borrowed that money from the bank, that $1,000, to put into the business in order to cover the losses, you cannot take that loss on your personal tax return.
Case in point, one example, don't do it yourself.